deferring tax is a major mistake. If we go back to 1944 all the way to 1981, the tax bracket was above 50% during that entire time. So what happens if you take a 37.5% tax rate and you defer into a rate that's like 60 or 70%, or at the top it was at 94%? There's this whole notion out there of accumulating wealth, and accumulation is a pretty slow, tedious process, and it's where a lot of the myths and misinformation come from. Like, accumulation is setting money aside, waiting for compound interest to kick in, and then, hopefully 30 years from now, people are okay, but they're not. And it's kind of this invest early, often and always, buy, hold, and pray. You're in it for the long haul notion. And how long does it take most people to go scrimp and save money to kick off cash flow 10, 20, 30 years from now? So what I'd rather do is let's spend 20, 30 minutes right now giving you a framework to save a boatload of tax. Because that's an immediate return, it's a guaranteed return, it adds right to your bottom line. So I just want to give you a framework that once you know this framework, I think it can save you a lot of money. And so the first part, it isn't revolutionary, but it's probably the hardest piece to do. The second part, I'll give you some additional insight. You might be managing the second part really well. The third part is where the major movements come. So there's three main tax parts we're going to cover. Before we do, I'm just going to say the two places where people make the biggest tax mistakes that are out there. The first tax mistake people make is they spend $1 to save 37 cents. I call that the tax tail wagging the dog. I just had someone tell me they bought a 6,000-pound vehicle, a Bentley, by the way, SUV, because they could write it off through Section 179. I'm like, well, did you want the Bentley? Because it's really expensive, and if you didn't want it, you just got screwed tax-wise. Like, yeah, you saved some, but you spent a lot of money. Like, forevermore, I want to show you today tax arbitrage, where if you spend $1 to save tax, you're getting more than $1 of real credit and savings. Should be more like 2 to 1 or something like that. So I'll give you concepts in tax arbitrage. The second big mistake people make is deferring tax. Deferring tax is a major mistake. If we go back to 1944 all the way to 1981, the tax bracket was above 50% during that entire time. So what happens if you take a 37.5% tax rate and you defer into a rate that's like 60 or 70%, or at the top it was at 94%? Well, what happens in that situation is you never want to take the money out, because if you hate paying tax today, I'm here to tell you, you're going to hate paying it more in the future. See, because what I found is with age comes bitterness sometimes, right? Like my grandma. When I'm like, Grandma, you're 70 and a half, you have to take this money out of your 401k, otherwise that required minimum distribution will give you tax and penalty. And it was the first time I heard her say the F word, to be honest. But not the last. Once that dam broke, But see, the committee kind of goes away. So like, if you hate paying tax, deferring it isn't necessarily saving it. It's delaying it. And if you don't have a clear exit strategy, or you don't have offsets, then what happens is it might as well be a 100% tax rate, because if you don't want to get to it and pay the tax on it, what good was it anyway? It's never being utilized. It's one of the worst things in a retirement plan to pass on to the next generation. You can do a stretch IRA, which means no one ever gets the money. I mean, it's like, yeah, you can keep deferring and delaying, but eventually there's going to be that day of reckoning, and when it is, well, you hope it doesn't all get taxed in 1 year, because it might be a larger sum of money, or what it does to the other assets. So if you do have those plans, there's things that you can do, like a rescue strategy. Like if you have a retirement plan, everyone, no matter how much money you make, how much wealth you have, you do have the right to convert that to a Roth. When you convert it to a Roth, if you can get a valuation on the assets to be less than what it's actually worth, like structured settlements do, then you're going to pay less tax, and at least you're now in a tax-free environment, so if taxes go up, you're not subject to that higher tax. So that would be one example of something you can do. What I did is, when I realized these things weren't great, I mean, here's how I recognized they weren't amazing. If you were to start a financial institution today, what do you want from people? You want their money, right? How often? Yeah, all the time. As often. How long do you want to hold on to it for? Forever. And then how much do you want to give them back when they want to withdraw? hence the retirement plan. It follows those 4 rules. Like, how awesome for a financial institution, because not only do they get to take fees on your money, they take fees on the government's money. There's restrictions to when you get to that money. There's automatic deposits now, and if you're an employer, typically your employees are automatically opted in with the new rules unless you choose differently, and if you don't, that's usually the default, so awesome. They get to put money in that even if they have double-digit interest rates with their other, credit cards and stuff. So I don't think deferral and delaying is the best thing. It typically doesn't work in most areas of life. The only time I found deferral and delaying to be really good is you should always file an extension on your taxes. Because if you file an extension, you've just bought more time for your amendments. So one of the things we're investigating right now, we've been working with this firm for a few months, and I'm now at the phase where I'm giving my taxes to them, but they go back and they look for everything from R&D credits and domestic production credits to continuing education credits. There's over 900 different rebates and incentives that the government gives, and they just got a dentist $110,000 back, a chiropractor $30,000 back. So now I'm going to see, I'm not a doctor, which disappoints my kids, to be honest. I always let them know how much I help doctors, but they don't care. They just would rather me help them at home. I'm like, you shouldn't, yeah, anyway, just a side note there. But that's an example of, like, you can go back, but if you file an extension, you have all the way till October, if that's what you filed your extension to go back 3 years. If you paid on time and filed in April, you're already chopped off a year. So even if you paid in full, everything's organized, that's one time it makes sense to procrastinate. All right, let's talk about these 3 tax buckets. The first bucket is the team, and it's what I call the 3 by 3 by 3 strategy, okay? Now, a tax team begins with record keeping. So you got to have some type of bookkeeper, controller, or CFO, because timely data is going to save you money. When you have that information, so you can make decisions along the way, that's going to be super useful. So the first one would be just some type of bookkeeping, right? The second one is a tax strategist. A tax strategist might be a CPA, but a CPA might not be a tax strategist. Some CPAs, their job is to file your taxes, not to talk to you about how to maximize tax deductions. And if you want to know whether they're a tax strategist or not, tax strategists don't use the word like, hey, my number one job is to keep you away from an audit. Hey, I'm really conservative. People that say that are letting you know you're overpaying on your taxes, and they've given the excuse up front so you won't be mad at them. Like, why be conservative if you're taking full advantage of the law within the law? Like, where it's not conservative, this would be a dumb idea, is not to report your income. That's what gets you into trouble in the US, not reporting your income. Another thing that gets you into trouble, if you take a deduction that's not allowed that was more than 20% of your overall tax deductions, there could be a 25% penalty. But there's a lot of people that are completely afraid of audits, but the IRS intends to audit you at least once during your lifetime. I look at an audit as market research for me. I personally do. And then for a lot of our clients, I look at it as like a 33% chance we're going to save more money and almost a 0% chance they're going to owe more. So if you're a sole proprietor, you have a 400% higher chance of audit, so incorporating helps you out. If you're an LLC or an S Corp, you're less likely to get the best auditors. Those are usually reserved for C corporations. So just a few things to kind of note. But if you did get audited, if you're well organized, because you have good bookkeeping, and you got those documents, and that you treat them extraordinarily well, and not you, but your tax team, and you never go to your audit because you're not the CPA, let your tax team handle it, because if they ask you a question you don't know, that's a red flag. They ask your tax team, it's not a red flag. The tax person gets to say, you know, I'm gonna have to check with David on that, and I'll get back to you. And by the way, that tax person has a direct line to the IRS, and you don't. So you just don't have to stress and worry, and there's plenty of opportunity to get money back in an audit, because now you can get really aggressive when they're sitting across from you, and they'll either leave quickly or you save a little bit of money. The third piece is a tax attorney, or at minimum a corporate attorney. Like, this is where most of the value of saving tax comes from, and because we have a lot of people in here, I'll actually just throw in, if you're in real estate, you might want a cost segregation engineer if you own commercial property, because you can accelerate your depreciation, and they can do a study for that. So that might be one to the team. But, okay, so we've got the 3 people here, your bookkeeper, your tax strategist, your tax attorney, and then every 3 months, you do a phone call with them. That phone call could be as little as 20 minutes in length or as long as 60 minutes in length. Your job is to be an entrepreneur on that phone call. Realize you're not talking to the IRS, you're not taking any action from that call, so it's your time to brainstorm. I have my call coming up in June. The first question I'm going to ask is, I just bought a Can-Am, those twin turbo, like go-kart, souped up things. Can I write that off? Now, they're going to say no. Then I'm going to say, but we just filmed it, and it's going to be at the beginning of every podcast. Every podcast guest gets to go for a ride. Like, I'm going to get some percentage of that written off. It won't be completely zero. I know it's not 100%. But I always start with just brainstorming. Hey, I'm going to Italy. Can I write off the trip? They go, no. I'm like, but I'm hosting a mastermind one of the days. This number of clients are coming to visit. We're going to go to where my great-grandfather's from with the drone, and we're going to get footage there. We're going to, by the end of the call, it was 55% of the trip I was able to write off. Because one, I had to do a corporate compliance meeting for every entity that I owned. So those mills, part of the travel, right? So that's your job, is just to ask questions. And if you say, can I write this off? And they say no, say in what case or what type of business could someone write this off? And that might give you some insight. Or you ask them questions like, what's the coolest tax strategy you've learned about or implemented since last time we talked? Could that apply to me? Their job is more to navigate the tax code and stay within the law. My job is to be an entrepreneur and to think like a strategist. So I'm just asking them a boatload of questions. We're actually recording my calls now and giving them to the people that work with us so they can just hear exactly how I do it. It'll be entertaining. I will give you that. I just ask the most ridiculous things on that, and then I go, no, I'm just kidding. We're not trying to write that off. But it's still fun to play with these guys. They don't always have the full sense of humor that they should. So 3 people that's on your team. You meet every 3 months, and then every 3 years you get a different set of eyes, and you go look back and see if you've missed something. So you can go back for, I mentioned R&D, so if you've done any software development, modified a CRM, done any technology that had to do with you used employees inside the United States, there's major credits from Section 199. Or domestic production, did you do research? Like now I'm doing research, right, with BYU University, which will just make even more people Google Garrett Gunderson LDS. That's the second most Googled thing. People want to know if I'm LDS. I look like Jesus, so that's confusing, or at least the Utah version of Jesus, not the Middle East one. But ultimately, BYU is the one that stepped up. So, yeah, I'm not Mormon. Just so you don't have to Google it. I don't want that becoming the #1 Google. So, as we have these meetings every 3 years, you can look back and amend the returns if something was missed. Domestic production is looking and finding out, did I do research, and that research lead to a product that created income? I can take a certain percentage of net revenue in credits. Above and beyond the cost or the hard cost, this becomes incentives that you can go back. So that would be one way of looking back, or maybe just something was missed. We just went through looking at amending someone's returns that became our client recently. They were paying 3.2% tax on every dollar of income that they had that wasn't required to be paid on. So it wasn't that we were that genius, but that was hundreds of thousands of dollars from a mistake. By getting a different set of eyes, they're able to go back and amend returns. So meet every quarter, look back every 3 years. What I tell these people when they go back and look every 3 years, every 3 years, I just say, I'll pay your fee. If you find something, I'll double it. And if you find something major, you'll either be added to the team or replace someone on the team. And by the way, that means you're going to get a lot more business than just me because of the business we're in. So that's what I do on that side. Okay, so that's the team. Kind of difficult to find these players sometimes. At Wealth Factory, we have them. We're constantly interviewing accountants. It's like a regular occurrence for us because they hit capacity issues, or they're not good at building a business, if they're good at tax strategy, or whatever that might be. All right, the second piece is deductions. So for deductions, I just have 2 main rules. Number 1, you ask anytime you make a purchase, does this relate to my business, or how does this relate to my business? And number 2, you document it. Now, you might take things like my Can-Am that I now put down on my list. I'm not actually filing taxes and writing that off. It's on my list because I'm going to ask on my quarterly meeting, can I write this off? Some people go, I don't think this is something I can write off, so they don't record it, and then it never has a chance. I'm going to have it have a chance until they tell me no, right? So number one, document it, right? Or number one, just make sure to ask how it relates to the business, and number two, document it. And then just find some of the cool nuances in the tax deduction world. Anyone in here know the Augusta rule? Did I talk about it last time? So the Augusta rule is awesome because you can rent out your home 14 days a year to your business. You can write that off. Just a funny story on this. So we were going to do the Augusta rule. David was at one of our events. And so I had hired some cooks. We were going to have a dinner at my house. I was renting out the house to the business. That's a tax deduction for the business. It's not taxable to me if it's 14 days or less. Well, at the same time, my wife had ordered something from this restoration hardware store that apparently white glove service means they drop the armoire right in the hallway when you open the door. So David and 5 other people, including Aaron that's with me, we had to get that thing up the stairs. I'm like, we're risking everybody's health getting this heavy thing up there. But we Augusta ruled that, so we got to write it off, right? Hosted that, but I don't have to claim that as personal income. Or I pay my kids $12,000 a year each, because you can pay them $12,000 a year, as long as you're actually having them do work worth $12,000 a year, and that's tax-free if they're 18 and under to them, but it's tax deductible to you. So those are some examples of tax deductions. I mean, there's hundreds of them out there, and there's a lot of ones that people miss simply because they just didn't document it and they didn't have these conversations with their tax team. When you're talking to your tax team between January and April, it's pretty worthless. When you're meeting with them right now in June, that's going to be a profound call. Number one, they can find out that I'm up from last year, so we can start to address that. There's no surprises. We can start to navigate things. Like, we'll just talk. Hey, does it make sense now to do a NING, a grantor defective income trust for my clients outside of Utah, which is almost everyone, so I don't have to pay Utah state tax? We decided not to do it last year. Well, June's a good time to talk about that because it's going to take 3, 4, 5 months to implement. And if I talk to them about it in December, the answer is going to be like, yeah, it might have been a good idea, but it's too late, right? So that's why every 3 months.